A beginner can have the same strategy as a professional trader and still lose money consistently. Why? Because psychology often matters more than knowledge. The market doesn't care how smart you are. It only cares about how well you can control yourself under pressure. The good news is that strong trading psychology is not built overnight. It is built through small daily habits. Tiny actions repeated every day eventually become powerful mental strengths. Habit 1. Look at the chart for 1 full minute before trading. Imagine walking into a room and making an important decision within 2 seconds. Most people would call that reckless, yet beginner traders do it every day. They open a chart, see a candle moving quickly, and immediately jump into a trade. The problem is that excitement creates urgency, and urgency often creates mistakes. Before entering any trade, force yourself to watch the chart for 1 full minute. Do nothing. Observe. Watch how price behaves. Notice whether the market is calm or chaotic. This small pause creates distance between emotion and action. Over time, this habit trains patience, one of the most valuable skills in trading. Sometimes that 1 minute is enough to stop you from making a terrible decision. Habit 2. Take 3 deep breaths before every trade. It sounds almost too simple. How can breathing improve trading? The answer lies in how your body responds to stress. When money is involved, your brain often treats trading like a survival situation. Your heart rate increases, your muscles tense, your thinking becomes emotional. Deep breathing sends a different message to your brain. It tells your nervous system that there is no emergency. Before entering a trade, slowly take 3 deep breaths. Inhale, pause, exhale, then repeat. You may be surprised how many impulsive trades disappear after 30 seconds of calm breathing. Professional traders understand that controlling emotions starts with controlling the body. Habit 3. Accept that you can be wrong. One of the biggest psychological traps in trading is the need to be right. Beginners often become emotionally attached to their predictions. Once they buy, they desperately want the market to rise. Once they sell, they desperately want the market to fall. But the market doesn't reward certainty, it rewards adaptability. Every morning, remind yourself of one simple truth. I may be wrong today. This statement is not weakness, it is wisdom. The trader who accepts being wrong can quickly exit a bad trade and move on. The trader who refuses to be wrong often watches a small loss become a disaster. The goal of trading is not to prove your intelligence. The goal is to protect your capital. Habit 4. Trade with smaller lot sizes. Many beginners believe larger positions create larger opportunities. What they don't realize is that larger positions also create larger emotions. When too much money is at risk, every candle feels personal. A tiny market movement suddenly feels like a life-changing event. Fear increases, stress increases, impulsive decisions increase. Trading smaller positions may seem boring, but boring is often profitable. Small positions allow your mind to remain objective. They give you the freedom to think clearly without emotional pressure. Remember, your first goal as a beginner is not to get rich. Your first goal is to survive long enough to learn. Habit 5. Stop watching your profit and loss constantly. Imagine driving a car while staring only at the fuel gauge. Sooner or later, you're going to crash. Many traders make the same mistake. They enter a trade and immediately become obsessed with profit and loss. Every dollar gained creates excitement. Every dollar lost creates fear. Their emotions rise and fall with every market fluctuation. Instead, focus on the quality of your trade. Focus on your plan. Focus on your rules. The profit will take care of itself. Professional traders understand that money is the result of good decisions. Beginners often focus only on the money, and that's exactly why emotions take control. The less you watch your profit and loss, the more clearly you can think. Habit 6. Write down why you entered the trade. Most beginner traders believe they will remember why they entered a trade, but something strange happens after the trade is placed. If the trade starts winning, they suddenly convince themselves they saw a perfect setup. If the trade starts losing, they begin inventing new reasons to stay in. This is how emotions quietly rewrite reality. Before entering a trade, write down one simple sentence explaining why you are taking it. It doesn't need to be complicated. Something as simple as, price bounced from support and the trend is bullish. That's enough. Now imagine the trade starts moving against you. Instead of making emotional decisions, you can look back at your original reason. Has the setup changed? Has your idea been proven wrong? Or are you simply reacting emotionally? A written reason acts like a photograph of your thinking before emotions take over. The market moves fast. Your journal helps your mind stay honest. Habit 7. Celebrate good decisions, not winning trades. A beginner trader named Alex once took a terrible trade. He ignored his rules, entered randomly, risked too much money, and somehow he made a profit. Alex felt like a genius. The next day he repeated the same behavior. This time he lost heavily. The lesson is simple. Winning does not always mean you traded well, and losing does not always mean you traded badly. A professional trader can follow every rule perfectly and still lose money because no setup wins 100% of the time. The market is based on probabilities, not certainty. Instead of asking, did I make money? Ask, did I follow my plan? If the answer is yes, celebrate. Because good decisions eventually produce good results. Bad decisions eventually produce bad results. The outcome of one trade means very little. The quality of your process means everything. Habit 8. Keep a trading journal. Imagine trying to improve at football without ever reviewing your games. Imagine trying to become a better musician without listening to your mistakes. It would be almost impossible. Yet many traders expect improvement without recording anything. A trading journal is one of the simplest and most powerful psychological tools available. At the end of each trading day, write down what you did right, what you did wrong, what you learned. That's it. Over time, patterns begin to appear. You might discover that you lose money whenever you trade while tired, or whenever you chase the market, or whenever you ignore your stop loss. The journal becomes a mirror. And sometimes the most valuable information in trading is learning about yourself. Habit 9. Walk away after a loss. Losing money hurts. There is no way around it. Even experienced traders feel disappointed after a losing trade. But beginners often make one critical mistake. They immediately try to win the money back. The loss creates frustration. The frustration creates urgency, and urgency creates bad decisions. Imagine touching a hot stove. You wouldn't immediately touch it again. You would step back. Trading should be no different. After a loss, stand up. Take a short walk. Drink water. Clear your mind. The market will still be there when you return. Many accounts have been destroyed not by the first loss, but by the emotional trades that followed it. Habit 10. Walk away after a big win. Most people understand the danger of losing. Few understand the danger of winning. After a large profit, confidence often transforms into overconfidence. The trader begins feeling invincible. They increase their position size, take lower quality setups, ignore their rules, and suddenly the market humbles them. A big win can create the illusion that you have mastered the market. But the market has a way of reminding everyone that nobody is in control. Whenever you have an unusually good trading day, consider ending the session early. Protect your profits. Protect your mindset. The goal is consistency, not excitement. A calm trader survives longer than an overconfident trader. Habit 11. Avoid revenge trading. Imagine someone insults you. Your first instinct may be to fight back. Revenge trading works in a similar way. The market takes money from you. Your ego becomes hurt, and suddenly you want revenge. You increase your lot size. You enter random trades. You abandon your strategy, not because the setup is good, but because your emotions demand action. The truth is simple. The market is not your enemy. It is not attacking you. It doesn't know who you are. When traders seek revenge against the market, they are really fighting themselves. And that is a battle they rarely win. Whenever you feel the urge to immediately recover a loss, stop. Recognize the emotion and remember that patience is usually more profitable than revenge. Habit 12. Review 1. Losing trade. Every day, most people love studying their successes. Very few enjoy studying their failures. But growth often hides inside mistakes. At the end of each trading day, choose one losing trade and analyze it. Ask yourself, did I follow my rules? Was the setup valid? Was I emotional? What could I improve next time? Do this consistently and your mistakes become teachers instead of enemies. Think about athletes watching recordings of their mistakes after a match. They do not do it to feel bad. They do it to improve. The same principle applies to trading. Every losing trade contains information. Your job is to find it. Habit 13. Stop predicting the market. One of the biggest beginner mistakes is trying to predict exactly what will happen next. They say, gold will definitely go up, or the market cannot possibly fall from here. The market loves proving certainty wrong. Professional traders understand a different truth. Nobody knows what happens next. Nobody, not the experts, not the analysts, not the people on social media. Successful trading is not about prediction. It is about probability. Instead of saying, I know this will happen, say, I believe this setup has a higher probability. That small change in language creates a huge change in psychology. It keeps your mind flexible, and flexible traders adapt faster than stubborn traders. Habit 14. Set a daily loss limit. Imagine entering a casino with no spending limit. How long would it take before emotions took over? Probably not very long. Many traders approach the market the same way. They lose one trade, then another, and keep trading until serious damage is done. A daily loss limit creates a protective wall. For example, if you lose a certain percentage or amount in one day, trading stops. No exceptions, no negotiations, no emotional debates. The day is over. This habit protects your capital, but more importantly, it protects your psychology. Some days the market simply does not fit your strategy. The smartest decision is knowing when to stop. Habit 15. Avoid trading. When angry, anger is one of the most dangerous emotions in trading. An angry mind does not seek good decisions. It seeks emotional relief. Maybe you argued with someone. Maybe you had a stressful day at work. Maybe a previous trade frustrated you. Whatever the reason, anger changes how you think. It reduces patience, increases impulsiveness, and encourages unnecessary risks. The market quickly punishes emotional decisions. Before opening your trading platform, ask yourself, how do I feel right now? If the answer includes anger, frustration, or intense stress, consider staying away from the charts. There will always be another opportunity tomorrow. But emotional trading today can create losses that take weeks to recover from. A trader who controls their emotions gains an advantage that no indicator can provide.